This is the revision for Advanced Audit and Assurance exam. And this is question 2, part B. Evaluation of assumptions used by management in preparing the cash flow forecast. Monthly sales figures. The forecast of monthly sales figures appears very optimistic. The expected value growth of 17% in the period to 30 June 2026 appears optimistic given that the new production plant is only expected to open in March 2026. The expectations of the population of the new product range in particular may be very optimistic. The successful launch of a new product is not guaranteed, even if it is supported by an advertising campaign. The advertising costs are only included in one period. However, the sales figures increase throughout the forecast. It is possible that additional marketing costs have been omitted or the increase in sales may be overstated. Even if the processing plant is ready for use from 31st March 2026, as stated in the forecast assumption, it only leaves 3 months for very significant increase in sales resulting from new product range produced at the plant to be achieved. Management may be manipulating the forecast to accelerate the cash inflow in order to reduce the payback period of the capital expenditure. New processing plant commencement of operation. Assuming that the loan is advanced in August 2025, this allows only 7 months for the construction and fitting of new processing plant, which seems at a short time frame for this to take place. Management may be being over optimistic in their assessment of how quickly the plant can be constructed and brought into use. In addition, there is no cash flow specific to factory startup costs, staff recruiting and training included in the cash flow forecast. There is a possibility that these costs have been omitted in error or deliberately in order to show the total cost of new processing plant as $15 million. Suggest the cost will all be covered in the loan which has been applied for and that no further cost will be incurred. Increase in production capacity. Management assumption that production capacity can be increased without any need for capital expenditure at existing production facility. Should be challenged by audit team. This assumption relies on there being spare capacity in the existing facilities, which may not be in the case. Reduction in operating expenses. Management's claim that economies of scale are being achieved, therefore improving operating margins may not be appropriate and is an attempt to overstate the cash position shown in the forecast. Opening a new production facility separately located from the company's other production plants in a foreign country is unlikely to achieve economies of scale, certainly not in the timescale suggested by the management. Tax expenses. There does not appear to be any cash flow relating to tax payments included in the forecast. If management is claiming that there will be no tax payments during the period covered by the forecast, this assertion needs to be approached with the professional skepticism, as it is unlikely that no tax payments at all will incur during this time. These payments may be deliberately omitted to improve the cash flow position as shown in the forecast. Foreign exchange transactions. The cash flow forecast does not indicate how foreign exchange transactions have been dealt with. Transactions relating to existing processing plant in new land, and more significantly, the capital expenditure and other transactions for the new plant in foreign are in a foreign currency, but the cash flow example, exchange gains and losses specific to these transactions are not shown in the forecast, though they may be included in interest payments or and other finance costs. Management could be ignoring these impacts relating to foreign exchange to reduce the volatility of cash flows as presented in the forecast. Finance costs. It is unusual that interest costs and other finance costs are completely static, indicating that the amount has not been accurately calculated. The amount also appears very low. If the category includes interest costs only, this amounts to only $60,000 per annum, which equates to only 0.4% of the $15 million loan. It appears that management is underestimating the interest cost, especially if the company has existing debt on which interest is being paid. It could also be the case that the company has existing debt which need to be repaid. There is no cash outflow relating to capital repayments within the forecast. Conclusion. Given the material uncertainty over going concern highlighted in the recent auditor's report, there is a significant risk that the assumptions used in preparation of cash flow forecasts are unrealistic and have been applied to make the cash flow forecast look more favorable in an attempt to secure the loan finance from the bank. Part 2. Examination procedures on the cash flow forecast. Recast the forecast to ensure it is arithmetically correct. Agree the opening cash flow balance of $50,000 to bank statement and management accounts. Discuss with appropriate personnel, sales director, product development team to obtain understanding of the new product ranges to be produced in Finland and the basis for management assumption regarding the expected popularity of the new products, leading to the forecast high levels of demand. Obtain supporting evidence for the projected increase in sales attributed to the new product range. For example, correspondence with potential customers and any signed customer contracts. Results of market research. Obtain and review the plans for marketing the new product ranges, including analysis of the planned expenditure of $100,000 and confirm there are no additional planned expenses to confirm completeness. Discuss with the sales director why marketing costs are only included in the period to 30 June 2026 and the justification for the continuing increase in sales when there is no planned marketing cost in future periods. Obtain and review supporting documentation for management's assertion that production levels in existing processing facilities will increase by 10%. Example, review production budgets, orders placed with suppliers for inputs to the processing, which should help to collaborate the assertion. Compare the monthly sale figures in the cash flow forecast to those in the profit forecast to ensure consistency. For the pattern of cash flow from sales, confirm that the timing of cash received from customers used in the forecast agrees with those evidence from past record. management accounts, a receivable listing, discuss any discrepancy with management, recalculate the patterns of cash flow based on management historical analysis of credit sales to confirm that the forecast has been properly prepared in the basis of this assumption. Obtain a breakdown showing the components of operating expenses. Perform analytical procedures comparing the forecast to the actual expenses included in the audited financial statements. In particular, reviewing for completeness and classification and discuss results from management. Analyze the trend in operating expenses compared with the trend in sales. Over the whole period of the cash flow, sales increased by 60% over the period of the forecast, whereas the operating expenses increased by much less, only 45% over the same period. Discuss the timing of the cash flow relating to operating expenses with the preparer of the forecast to obtain understanding of how these figures have been determined. Compare the level of operating expenses with historical financial information and with the profit forecast, and discuss any significant variance with management. Assess whether there are any missing categories of cash flows. Example, there does not appear to be any cash flows relating to tax payments. Discuss any potentially omitted expense categories with management to understand why they have not been included in the forecast. Inquire with management how foreign exchange transactions have been dealt with in the forecast. Agree interest costs to existing and potential agree interest costs to existing and potential loan documents or other relevant supporting documentation for the planned capital expenditure. Obtain a detailed breakdown of costs included in the $15 million planned expenditure and agree a sample of costs to supporting documentation. Example, cost for construction, cost of land acquisition, cost from suppliers of plant and machinery. To verify the completeness of the estimated cost of the construction of new facility. Confirm the exchange rate which has been used to determine the dollar value of the anticipated capital expenditure which has been included in the forecast. Confirm by agreeing to historical financial statement that the level of dividend of $100,000 each year appears in line with previous payments. Given the company's going concern problem, it may be the dividends have not been paid in recent years, in which case the forecast level of dividend payable should be discussed with management. Review the planned capital expenditure for any missing expenses. Example, does it include incidental costs such as installing health and safety equipment, testing of machinery prior to use? Inquire with management to understand whether or how startup costs for the new processing facilities, which are not capital in nature, have been included in the cash flow forecast, for example, recruitment and training of staff. Obtain supporting evidence that the new processing facility will be ready for use on 31st March 2026 as claimed by management, for example, project plan provided by the construction firm. Obtain the published financial statement and auditor's report of FLINCO for the year ended 31st March 2025 and review the content of the auditor's report to confirm the opinion issued. and the material uncertainty relating to the going concern section. Given the material uncertainty relating to a going concern highlighted in the auditor's report, request permission to communicate with the auditor to discuss the going concern issues, to obtain understanding and to assist in evaluating the assumptions underpinning the cash flow forecast. Assuming that permissions is given to communicate with the auditor, discuss the specific nature of liquidity issue as mentioned in the auditor's report, have previously applications for finance being rejected. Are there any specific factors contributing to financial distress in this financial year? Confirm that the assumptions underpinning the cash flow forecast are consistent with those used in the rest of the business plan to be provided to Morton Bank. Review the outcomes of previous management forecasts and assess their accuracy compared to actual data. Assess the competence and experience of the preparer of the forecast. Confirm the consistency of the accounting policies used in the preparation of forecast financial statements with those used in the last audited financial statements. For example, of operating expenses, review the supporting documentation such as invoices and utility bills and agree the amount paid each month to cash flow. Agree the predicted collection and payment periods to the most recent sales ledger and purchase ledgers. Perform sensitivity analysis on the cash flow forecast by varying the key assumptions, in particular in relation to growth rate, and payment periods, and assessing the impact of this variation on the company's forecast cash position. Obtain written representation from management, confirming the reasonableness of their assumption and that all relevant information has been provided to Calico. Requested confirmation from the bank of the potential terms of the additional finance being negotiated to confirm the interest rate. Review board minutes for approval of the purchase and approval that the finance will be raised from Morton's Bank. Inquire about any other potential sources of finance in case Morton Bank fails to provide the full amount required, or in case the new premises cost more than the estimated amount. Inspect the cash flow from 1st July 2025 to see if there are any significant cash transactions which do not appear to have been included in the forecast.